All right, everybody. Welcome to our Defender Capital Management December update. My name is Daniel Dreistra. I'm the current president of DCM, and I'm here with Tayden, our portfolio manager, and Nathan, our senior economist. So we're going to take you through how our portfolio has performed in the past 45 days, and and Nathan's going to talk about some of the economic impacts that have been going on in the world that are affecting our portfolio as well. So we'll get started with a report from Tayden. So.
All right, so one of the first things to note about November is we did beat the market slightly. This is a little different than our trend. The whole semester we have been losing to the market a little bit, but currently we're still sitting pretty good. We have about 33,000 in cash after our most recent buy, which a lot of that cash is from the most recent $55,000 donation, which helps us a lot. And then this slide is just our performance from our last donation, which took place on January 13, and that's all the way up to November 30. So you can see we've kind of been beating the market a good amount since then. Of course, everything's down, but hopefully things will start turning around soon.
Yeah, so in the month of November, we made one major purchase that was of a Canadian utility named Fortis. So Fortis is a company headquartered in St. John's, Newfoundland, but they have operations all over North America and the Caribbean. So they have, I think, 12 distinct utilities serving 3.4 million customers, electricity and natural gas hookups. So this is a very diverse company. They have a lot of different operations all over. So they're not exposed to any one market. And as well, their revenue is 99% regulated, which we really liked. They have a $31 billion rate base. So this cash flow is very predictable. It's very constant, and it won't be affected in the event of a major economic downturn. So yeah, and then their management has been very good over the past 50 years. They've raised their dividend for 49 consecutive years, and they project to continue to do so for the next through 2027, with a fairly conservative payout ratio of 79% for the industry. And then we made a second purchase just a few days ago here in December of Digital Realty Trust, which is a real estate investment trust based here in the US. They own 300 data centers throughout the world in 25 different countries. They have lots of major customers like Facebook, Oracle, Verizon, IBM, all big name brands. They've also increased their dividend every year since they've IPO'd in 2004 at a growth rate of nearly 10% a year. So we are really excited about DLR. We think it's a very safe bet as well. So those are the two purchases we made in November and December. We made no sales. So now Nathan is going to come on and talk about the economic impacts of different things on our portfolio. So,
as I'm sure all of you are aware, the market just recently has been somewhat volatile, and part of that's due to whether it's Russian-Ukraine relations that are occurring in Europe. But the main things that we kind of took into our decisions first was the Fed news, as I'm sure all of you are keeping up with. The Fed did in the month of November increase by 0.75% their interest rates. And just the other day, they did increase interest rates again by 0.5%. And they're trying to taper the increases that they are making, but they do want to keep inflation in check. And the Fed is expecting unemployment to jump from 3.7% in the month of October, November to about 4.5 to 5% in 2023. So that's just something to watch out for. And the Fed is also expecting interest rates to settle somewhere in the range of 4.75% to 5.25%, which is up from that 4.5% to 5% marker that they wanted. And really what's determining the Fed's decision is the labor market. They're wanting the labor market to kind of cool down. And as you'll see in this next slide, the labor market is kind of doing the opposite of what the Fed is wanting. Employers added 263,000 jobs in the month of November, and unemployment stayed at that 3.7%. And for 3 months ending November, the average hourly earnings rose 5.8% annualized, which is up from that 3.9% in October. And really what the Fed is looking for is that hourly earnings rate to flatten out and maybe decrease in what people are getting. And right now, this increase in the amount of money that people are getting is signifying to the Fed that companies and specifically employees aren't necessarily feeling the squeeze of these rate hikes. And so if these companies, if these employees aren't feeling the squeeze of these rate hikes, then obviously the Fed needs to continue to do them. And that's why we saw 0.75% for so long, and really just keeping an eye on that. And then just these impacted our decisions as we think that there could be a recession. There's rumor that one might occur coming 2023, 2024. And so we wanted to bolster our portfolio in that nature. As Dan talked about, both of those stocks paid off a pretty solid and steady dividend. As he mentioned, Fortis has a very steady income that they can expect to have each and every year. So having that in our portfolio helps balance us, helps us be more conservative. And then DLR, as they're managing more the data that these companies have, they're not going to be as exposed to the interest rates that are fluctuating. So when companies are obtaining more data, they're going to need somewhere to house it. So that's also what we saw as a safe investment. So adding these two, from what we saw, safe investments to our portfolio, as I mentioned, will kind of help bolster us in a time of really volatility and potential recession on the outlook for our portfolio.
Yeah, so in conclusion, just to wrap everything up, as Nathan said, we made a couple of conservative decisions this in the past month, looking forward to a sort of volatile economic future. And that's kind of the story for the past 45 days. And then we're going to go on break here for the next few weeks and come back in January. And we'll have another report, hopefully by January, about the first week of February for wrapping up January as well. So if you have any suggestions for this report, this is a new thing we're doing. So if you like it, want to add anything, please let me know. So thank you.